Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Navigate the Tax Cuts and Jobs Act for Forest Products. And before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls of the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have two presenters with us today from Moss Adams. We have Brent Laird, partner, and Tyler Harris, senior manager. Their bios and contact information are located in your webcast console. And now I would like to turn the floor over to Brent to get the presentation started.
Thank you, Amy. So as we've talked about already, we're here to talk about the Tax Cuts and Jobs Act and kind of what's happening with that as we near the end of the temporary provisions that have been placed in here. Just a quick background about the act. It was passed in 2017. It was, we call it kind of Trump's Tax Act. It was commonly known as the TCJA. And it was done through a process called a reconciliation. And so because of that, not everything in it is permanent. And there were kind of give and takes when the bill was put together. And so some of the deductions go away. Some of the limitations or hikes also go away, where some of the provisions will remain permanent and continue going forward. So we're going to talk through that real quick. And like I said, a lot of them expire at the end of next year, and we're going to go through just a quick run through of what those look like. With tax planning, there's always this kind of this air of uncertainty out there as to what's going to happen. Right now, a lot of you are probably aware that there's some elections out there. We've all probably been getting plenty of advertisements, text messages, emails, letting us know that things are going on. And quite frankly, that's one of those things that really creates a lot of uncertainty for us, as we're not sure who's going to win, right? We had 13, we had Obama, and the Democrats get a lot of the control in them, and they passed a large sweeping tax act in 13, which changed a lot of things. And then on the other side, we had Trump, and the Republicans, obtained power in 17, and they passed a very large, tax change, one of the largest changes that we've ever seen. And so, as we go into election season here, I think we're all kind of curious to see what the outcomes are, because it seems like one of the things that's attacked first anymore is the tax policies. And so while we can't plan for all that's coming yet, we can talk about what's going to happen outside of that part of things. And so we can kind of plan with what we do know. So just kind of a heads up on that. A lot of the stuff ends at the end of next year. So really need to start getting into planning mode sooner than later in order to be prepared for the changes that are upcoming. And if there's any moves that we want to make, we need to start thinking about those now as we get into the next year here. One of the largest changes that really happened was the corporate tax rate being reduced to 21%. Previously, that rate was at 35%, so it was a huge reduction in the corporate tax when it went from 35% to 21%. That is a provision that is not set to expire. That's going to continue going forward. It was a permanent change. A temporary change that was put in place was the qualified business income deduction. The qualified business income deduction was an extra 20% deduction thrown for qualified business income. So income in the U.S. that qualified received that reduction. And we really think of it a lot more like a rate reduction when we're kind of planning around it. So we thought top tax bracket's 37%. this really brings that down to 29.8%. And so it put partnerships, S corporations, and small businesses more on par with a corporate tax. Well, when that goes away here at the end of next year, we're going to be looking at quite a difference in rate between corporations and partnerships and S corps. We're talking 37% versus 21%, and so it's a pretty big disparity. And so we'll see if anything's done to adjust for that. But currently, it's something to be aware of that, those rates are going to be higher for our flow through clients. I think on the forest product side of things, as Tyler and I were talking through things, this really makes the 631A calculation a lot more powerful. If we're going to have ordinary income rates up at 37% again, the ability to have more income at capital gains rates, 15 to 20% versus 37, it's obviously going to be a big deal. So we're going to probably need to look harder at our 631A calculations for our timberland owners to see, if there are any additional opportunities or any ways we can get better results there, because that's going to be a game changer with ordinary income rates coming up so much. A few considerations, just questions that have kind of posed here at the bottom, for kind of food for thought things. Do we think the 21% corporate tax is going to remain? I think that's an interesting thing depending on which side takes over. I'm sure that will be revisited post-election. As we structure new entities, knowing the rate differential, I think it's going to be pushing a lot of people more to the corporate environment. So we'll have to really consider that as we plan around things. And there might also be the potential to recapitalize businesses to take advantage of that lower rate. And then another thing that might be considered is if we do know rates are going up, there might be a reason to push income into the current year or into 2025, while we can still get that qualified business income deduction. We can also do this by changing our accounting methods if there's some room there. So really a big change coming up. This is one that I would definitely circle as something that could impact a fair amount of people. Another one that affects pretty much everyone on a wide sweeping range is bonus depreciation. Bonus depreciation allows basically the immediate expensing of fixed assets that are placed in service in the year. It was at 100% when the Act first came out in 2018. It's cliffed down a little bit each year. Right now we have a 60% bonus threshold for 24. It cliffs down to 40% in 2025, and then another 20% before eventually going away. So that is a very large change for those that are, they're very heavy, asset heavy, like mills, equipment, as we put in those assets into service. Something to be aware of that, the sooner we get them in, the more immediate write-off we get right away. But just being aware that will go down over time. 179 more or less kind of stays the same. You still get $1 million. It's indexed for inflation. When we thought about our forest products clients, we thought, potentially logging roads, this might apply to more, where we have just been taking makers depreciation, taking the bonus depreciation, running it out. It might make sense to go to a units of production method, based on how much we're harvesting in certain tracts, maybe to go back to that model to make those 168F elections. So something that we're thinking through and considering, and we'll visit with our clients on as we continue on. All right, pass-through entity tax, elections in the state and local tax cap. So for those that are unaware of what the SALT cap is it was an itemized deduction that was previously it was not limited. You would take your state and local taxes, so taxes paid to your state, your property taxes, add them together. That was your Schedule A deduction. As part of the change in 17, that was capped at $10,000, which really penalized taxpayers in high income tax states. States like Oregon, California, where you're paying 10%, 12%. Effectively, to lose that deduction on your business income was a pretty large deal. And so states didn't like this, so they came up with these workaround programs where you would pay basically the individual taxes would actually get paid at the business level. The business would take the deduction, a credit would flow out to the individuals, and the individuals would effectively kind of back into a way to be able to deduct their personal income taxes at the business level. So that was the workaround. Most of these programs are set to expire when the SALT cap goes away, which is at the end of 25. So that'll be nice from a taxpayer, compliance standpoint. You won't have to do as much, filing those extra returns to get that benefit. That will just kind of go back in. So I think most practitioners are a little excited. Those programs can be complicated and have carve-outs for trust and different entities that aren't allowed. So should make life a little bit easier. I know a lot of people are excited for the SALT cap to go away, and have been pushing for it to go away for a while. Another limitation that was put in place, a revenue raiser, was the excess business loss limitation rules. And effectively, the way this works is that you're only allowed to have so much of your business losses offset your other income, your portfolio income, your wages. Any amount that is past those threshold amounts gets carried forward as an NOL. Is how the mechanism was set up to work. So, put numbers to it. If you had, $1 million business loss, but you had $2 million of other income, it's only going to let you offset the first $610,000 against that business loss against that other income. So you'd still get taxed on the 1.4 million or so and change. So it was a rule that, it was kind of a trap rule, because you might have a really bad year from a business standpoint, but your other income was still positive. And so you thought you weren't going to have to pay taxes, but then as a result, it was like, oh, your business losses didn't wipe off everything again. So really kind of was a revenue raiser for the IRS, but it was disappointing, I think, for taxpayers when you had those big loss years, but yet still had to pay taxes on your other income that you were generating, which was different than the way it used to be. One of the things about this one that's unique is it's actually going to expire at the end of 28. When the Inflation Reduction Act went in, this was kind of, in order to justify some of the deductions in that bill, they raised up the limitation here, or extended it out up to 2028. So this one exists for a few more years, but it is an expiring provision, so something to be aware of. Wish it was expiring end of next year. Unfortunately, it's end of 28. Expiring fringe benefits, won't spend a ton of time on these, but just kind of a heads up that some of these are going away or have changed. Probably the one that we see the most is just your on-site meals, or if you have a cafeteria expenses. Right now, you were allowed to deduct half of those expenses. Now that deduction goes away at the end of 26 here, or starting in 26, that deduction goes away. So those are kind of the temporary ones that we've chosen to highlight. Now we're going to go through the provisions that are not changing. So these are the things that are going to stay going forward. We've talked about the corporate tax rate remaining at 21%. Like I mentioned before, that could be something that gets targeted in a post-election season based on some of the candidates' plans. NOLs, those are continuing to be limited to 80% of taxable income, and they are carried forward indefinitely. The old rules used to be you carried it back a few years, then you could carry it forward. This rule is just carry it forward as long as you have it. Use it unless you die. And it's kind of how that one will work. One of the hairier deduction limitations that came into play was the 163J interest expense limitation. I think a lot of people were hoping that that was going to go away, but no, unfortunately, that one is permanent, so we're stuck with that. Note on net operating losses, in regards to the excess business loss rules, those are treated the same. So an excess business loss becomes an NOL, and then that NOL will continue to roll forward indefinitely. So excess business losses and NOLs really have the same treatment because they kind of become the same thing. Another thing that changed as part of the TCJA that's continuing to stay is that like-kind exchanges are limited just to real property. So just land and buildings are what can be exchanged, other real property there. Equipment, automobiles are no longer subject to that treatment, which for the most part makes things a little bit easier from a record-keeping standpoint, but something to be aware of. And then R&E expenses. This was a hot topic about 1.5 years, 2 years ago, when these things, we could no longer expense them immediately. This was plugged into the bill, but it didn't kind of had a later implementation date. And so a lot of people didn't realize that we had to start capitalizing those. So those, we do have to capitalize R&D expenses. They're amortized over 5 years still, and then 15 if they're done internationally. And then a lot of There were a lot of exemptions put in for small businesses based around things like inventory, methods of accounting. Those things are all continuing to stay as well. So, and then real quick, just a few other ones that are not changing. 179 continues to stay at the 1 million. The corporate AMT was repealed. It's still going to no longer be there. They did put in a different kind of minimum tax as part of the Inflation Reduction Act, but it really only applies to taxers with over $1 billion of income, so we don't see that very often. Entertainment expenses, back when we had M&E, now M&E is just M. And then also that the parking rules that we can't pay for parking anymore. So those are the kind of the business provisions. Internationally, I'm not going to spend a ton of time because I want to make sure Tyler has time to talk about individuals and really where the rubber meets the road for a lot of taxpayers. But just international, for those that have international operations, we have effectively a 3% increase on those incomes. On GILTI, FDII, we're seeing about a 3% increase from 24 to 26. So we do see international rates creeping up a little bit as well as part of those changes. And with that said, I will pass it on over to Tyler.
Perfect. Thanks, Brent. Well, thanks for spending some time with us this morning. Like Brent mentioned, I'm going to talk about some individual provisions. So we've touched on this a little bit, but just to reiterate, when the TCJA expires, the top individual tax rate is going to jump to 39.6%. This is a significant increase, especially with that loss of the QBI deduction. For a while here, we were kind of using a 29.6% rate for ordinary income, but really, it's so that's a 10 percentage point increase up to 39.6. Like Brent mentioned, this does make your 631A calculations or any ordinary to capital or qualified dividend conversion that much more powerful, that much more beneficial, and probably bears a little bit of analysis to make sure that we're really capturing all that benefit. When I was thinking about 631A, for instance, one of the qualifications there is that you have to hold the timber for a year before it's harvested in order to gain those rates. And so maybe now is the time, assuming, of course, business needs, prevail, but assuming the business need is there, you acquire some timberland now or a timber contract or something to start that clock so that in 2026, you can, capture that rate differential. I was also thinking about, some of you might have exports, and if you do, and you're utilizing a IC disc currently, it might be worth a revisit to make sure that you are fully maximizing that commission calculation. There's many different ways to determine that commission, and so with the rates going, it might just be time to just reevaluate and make sure you're getting the full benefit there. If you have exports and you're not using a disc, might be time to consider getting an IC disc put in place. And, not going into too much details there, but really, at the end of the day, all it is a rate change that you don't have to change the economics of what you're doing. You still are selling to your customer. You just have a tax entity that's inserted in the middle that, that basically gets you to a place where your income that would have otherwise been ordinary, taxed at 39.6%, is then taxed at the qualified dividend rate of 20%. Kind of a nice little deal there if you have exports. One other thing, not to harp on disc for too much longer, but there is a lot of people out there use what's called a producer loan. And so basically we're deferring income into the future. Now, with the election uncertainties and some of the things that have been talked about in the media, maybe you're concerned that the qualified dividend rate is going to go away, that we won't have a 15% or a 20% rate in the future. Maybe it's time to revisit your producer loans and decide, maybe I need to pay those now, recognize the income now on rates that I know exist today. Just something to be thinking about and analyzing. Brent mentioned roads, and I agree there. We were, historically, we'd make those 168F elections frequently. That was kind of the norm because the harvest was typically shorter than the 15-year road depreciable life period, so you could recover your deductions more quickly. with makers at 100%, that seemed like a no-brainer to adopt makers and just expense the roads right away. But we are now to a place where bonus depreciation is slowing down, and you will be experiencing that 15-year recovery time period. So assessing whether that election makes sense or not is more relevant. So I'm not going to talk about AMT all that much, other than the fact that it's probably going to be more relevant. The exemptions are going down, the phase outs are going down. If you are someone who can effectively convert all of your ordinary income into the lower rates, and you're taking advantage of the state and local tax deduction, which is not allowed for AMT purposes, you might be subject to AMT in the future. So just something to think about as you're planning, for what taxes look like in 2026. Personal and dependent exemptions are coming back. Probably not going to impact a ton of people on this call because there is a high income taxpayer kickout, but just to be aware, that is coming back. Standard deduction currently is at a very high rate historically. It's going to decrease to pre-TCJA levels. And really all that means is that more people are going to be subject to itemized deductions than the past. People were probably itemizing anyways in order to take advantage at the state level, but this will just make it so that, you got to keep those charitable receipts, your mortgage interest deduction, all the different things are going to become relevant on more people's tax returns. So speaking of itemized deductions, we touched on this already, but it bears repeating. The state and local tax deduction is going, the limitations going away. And as Brent mentioned, this is, great news for a lot of people. Doing those salt cap workarounds was not only time consuming, it was complicated. If you're a multi-state organization with residents who live all over the place, who could participate, who can't participate, became very problematic and just cumbersome to work through. So I know personally I'm looking forward to the state and local tax deduction limitation going away, so that we can just deduct your wage withholdings, deduct your estimated tax payments, without any issue there. Mortgage interest deduction, the only thing I'll say about this is just the debt level that supports the interest deduction is going to increase from 750,000 to 1 million. Maybe that's relevant if you are someone who's buying a home right now, especially with our increased housing pricing. That extra 250,000 might help free up some deduction. If you're charitably inclined, currently you can contribute 60% of your AGI via cash contributions. So you have $100,000 of AGI, you could theoretically contribute $60,000 and end up with $40,000 of taxable income. That is reducing slightly in 26. It'll be 50%. So, maybe taking a look at what your charitable plans are, revisiting your donor advised funds, all the things just need to be looked at again because the rates or the percentages are changing. Not going to spend a whole lot of time talking about personal casualty losses, other than the fact that they're back. They used to be only for federally declared disaster losses. I hope that's not a situation you find yourself in, but if you do, please reach out to someone. An interesting one that's coming back, that was here, was the miscellaneous itemized deductions. So now your tax prep fees are deductible, your investment fees are deductible, your safety deposit boxes, unreimbursed employee expenses. I mean, all I really hear here is that our tax prep fees get to go up because now they're deductible. So look forward to that. It's just a joke. Touch on the child tax credit here shortly. So currently you get $2,000 per kid, and the AGI phase out is $400,000. So a lot of people are taking advantage of the child tax credit. That's set to decrease and also apply to less and less people. So the credit's going to go from 2,000 down to 1,000, and the AGI phase out is going to be at 110,000. So pretty easy to get there these days. What is interesting here is like if you do have a situation where you have a bad tax year, in your flow through entity, or I shouldn't say bad tax year, if the tax planning gets you to a tax loss in your flow through, you can offset all your other income, especially if you're active in the company, and you could get to a place where you can take advantage of these credits. They are just, greatly reduced, and that $1,000 is not indexed for inflation. One of the last kind of bigger topics I wanted to talk about was the estate and gift tax exemptions. Likely you've heard about this at some point, I would imagine, in the news or in the media or from your providers. But right now, the individual exemption level is 13.6 million, and effectively means that you can transfer wealth of that amount without incurring the 40% estate tax. And the thing I just want to reiterate here is, transferring wealth can be something that is, a little bit unnerving, especially if you rely on current cash flows. But there's ways to do it so that you can retain those cash flows. I mean, there's simple ways like setting up a SLAT if you have a spouse. There's more complicated ways like setting up potentially defective grantor trusts. There's things all in the middle there that can be done to help achieve your cash flow goals so that you can transfer wealth if you desire to, but also maintain access to funds so you can live the life you want to live. But in order to get there, it starts with a conversation. And so if you haven't talked with someone, now is the time to do so. That 13.6 million is kind of a use it or lose it. Once it drops down to 5.6, that excess is kind of gone. And so that's why a lot of us are kind of pushing for this now is, take advantage of this adjustment. If you have a plan in place and estate plan already in place, it's time to revisit and make sure that what is happening is in line with what you want to happen and also makes sense in light of these new exemptions. Skip this one. All right, so next steps. I mean, really what this comes down to is just thinking about what's coming and modeling and revisiting now. Do your deductions make sense? Is your repairs and maintenance, policy, does that make sense? Should we be deducting more things in those years where tax rates jump? Depletion pools, is your depletion methodology set up in a way that maximizes deductions in anticipation of the increased tax rates? Inventory methodologies. I mean, all the different things that you would experience as either a timberland owner, as a manufacturer, and anything in between. Now is the time to take a look, revisit, make sure you're set up to take advantage of the higher rates that are coming, and we're here to help. Of course, talk with your attorneys, talk with your CPAs, but please reach out to someone and don't let this catch you off guard. So with that, I'll kick it over to questions. We just have a few minutes here. I see there's a question in the chat already. Mark, I think we answered your question. Those losses, unused business losses, effectively become NOLs the next year, and then they carry forward forever. They can only offset 80% of income in that next year, though. Just to be aware, the loss rules have gotten a lot more complicated. Different buckets of losses now, and they don't fully offset income like they used to. I don't know if there's any other questions out there. All right. Well, if there are more questions, feel free to contact Brent or I directly, and we're happy to get those answers for you. And so I will kick it back over to Amy.
All right, thank you. And thank you, Brent and Tyler, for a great presentation today. And to our audience, like Tyler mentioned, if you have further questions or comments, please reach out to us and we would be happy to continue this conversation. You can drop a note in the Q&A window or reach out to our presenters directly. Their contact information is linked in your console. And then finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. And again, thank you for joining us. Take care, everyone.